The moment you finally own your own home is supposed to be one of life's greatest milestones. For 32-year-old Michael, this dream was about to come true and turn into his biggest financial regret. In today's economy, interest rates are rising and changing the game completely, making the difference between financial freedom and a 30-year trap that most homebuyers never see coming.
I can't believe I finally did it. My own place, my own rules, no more landlords. I got a great deal, only $350,000. The market's insane right now, but I locked it in.
Welcome to Walk to Money, Walking to Success. Michael is 32, earns $85,000 a year as a marketing specialist, and has spent the last 5 years saving for his first home. He's done everything by the book, built good credit, saved for a down payment, and waited for the right property.
This property won't last long at $350,000. It's honestly underpriced for the neighborhood.
I've been saving for years. I could put 20% down to avoid PMI.
Great! With your credit score and down payment, we can offer you a 30-year fixed-rate mortgage at 7.2%.
That seems a bit high, wasn't it? Around 3% a couple years ago?
Interest rates have changed dramatically. This is actually competitive in today's market.
The broker wasn't lying. Mortgage rates have more than doubled in recent years. But what Michael failed to understand was the massive impact this would have on his actual cost of home ownership.
So many documents to sign. I don't even know what it is, all of this, but I have a great deal.
Just standard paperwork. Initial here, and sign at the bottom of each page.
Like most home buyers, Michael focused on the purchase price and down payment, not the total cost of the loan over 30 years.
This place is perfect. The monthly payment is a bit higher than my rent was, but now I'm building equity instead of throwing money away.
Michael was about to discover the cold, hard math of high interest rates. On his $280,000 loan at 7.2% interest, Michael's monthly payment is about $1,900. But here's the shocking part. In his first payment, only $320 goes toward paying down the principal. The remaining $1,580 is pure interest.
That's over $19,000 a year just in interest? This can't be right. The idea was to save money.
But it was right. And it gets worse. Over the life of his 30-year mortgage, Michael will pay the bank almost $400,000 in interest alone. That's more than the purchase price of the house itself. His $350,000 dream home will actually cost more than the double. If Michael had been able to secure the 3% interest rate available just a few years ago, the total interest over 30 years would be just $143,000. A difference of over $250,000.
Unfortunately, this is the reality for many homebuyers right now. High interest rates increase the total cost of home ownership.
So what can I do? I've already bought the house. I cannot return it to the bank.
You have several options, but none of them are perfect.
Option 1. Michael could wait and hope that interest rates drop significantly, then refinance his mortgage. But there's no guarantee rates will fall anytime soon, and refinancing comes with its own costs. Option 2. Michael could make additional principal payments to reduce the overall interest paid and shorten the loan term. Every extra dollar paid toward principal saves future interest and will become in less time of mortgage payments. Option 3. Worst case, Michael could sell the property and cut his losses. But this comes with transaction costs and potential market risks. That could make Michael lose a lot of money.
I wish I had understood this before I bought. I was so focused on the purchase price.
You're not alone. Most buyers don't realize how much interest rates impact the true cost of their home.
What could Michael have done differently? Several things. First, he could have waited for interest rates to potentially decrease before buying. Second, he could have purchased a less expensive property to reduce the loan amount and total interest paid. Third, he could have considered a 15-year mortgage instead of a 30-year. Despite higher monthly payments, the total interest paid is dramatically lower due to both the shorter term and typically lower interest rates.
After learning my lesson the hard way, I decided to make bi-weekly payments and add an extra $200 per month toward principal. It's tight on my budget, but I'll save over $100,000 in interest and pay off my home 8 years earlier. The biggest mistake I made was bought at high interest rates. I was not understanding how those rates would impact the total cost of my home. I was focused on the sticker price, not the financing.
Today's mortgage rates remain historically high, transforming the economics of homeownership. In this environment, understanding the true cost of financing is more important than ever. Here are the critical lessons from Michael's story. The interest rate affects your total cost far more than most buyers realize. A higher down payment reduces both your loan amount and total interest paid. Additional principal payments can significantly reduce your total interest cost. Always calculate the total cost of the home over the full loan term. Consider alternative strategies like 15-year mortgages or waiting for better rates. Don't make the same expensive mistake Michael did. Get good advice from financial and real estate experts that you truly trust. Have you experienced interest rate shock with a recent purchase? Or are you weighing whether to buy now or wait for rates to potentially fall? Share your situation in the comments, and I'll personally respond with insights tailored to your circumstances. If you like this video, subscribe, share it, and hit the bell button for notifications. This is Walk to Money, walking to financial success. See you soon in the next video.